Hello everyone, welcome to our session on circuit breakers. My name is Dr. Ragvi and I will explain you how circuit breakers work in case of stock exchanges. Today we will explore the concept of circuit breakers in stock exchanges to understand what they are and how they play a crucial role in financial markets by preventing excessive price volatility. Now, what are these circuit breakers? Circuit breakers are mechanisms implemented on stock exchanges to temporarily halt trading on a security or the market as a whole if prices hit extreme levels within a short period. This mechanism is crucial to prevent panic selling or buying, which can lead to uncontrolled price movements by pausing trading. Circuit breakers allow investors to digest information and make more considered decisions. Thus, it helps in maintaining market order and investor confidence. Now, this helps the exchange and clearing houses to monitor how their members are behaving and reacting to different informations. How do they work? Circuit breakers function by setting thresholds for permissible price movements within a trading day. For instance, if a stock's price rises or falls beyond a predetermined limit, let's say 5% from the previous day's closing price, the trading in that stock is halted for a specific period, typically for 30 minutes. This pause provides cooling off period to ensure that market participants have time to assess their positions and actions in light of new development. Let us take one example. Previous day's closing price of A share limited was rupees 100. Today, it will be allowed to increase till 105 or decrease till 95. This 105 is known as upper circuit limit and 95 is known as lower circuit limit. In case if it goes beyond this range, that is from between 95 or till 105, it is perfectly fine. But if it goes below 95 or goes above 105, then a circuit breaker is applied and trading in just that script is stopped for 30 minutes. If extreme volatility continues further, trading halts can occur, potentially leading to suspension of trading for the day if limits are breached repeatedly. Again, if this breach happens, then the trading is resumed again. Margins of fluctuations now would be altered in this manner. That is 4% additional variation would be allowed. That is now the variation allowed is up till 9%. So the range now becomes 91, which is the lower circuit, and 109, which is the upper circuit. If the situation persists, then the trading would be halted for 1 hour, and if the same continues again, then the trading for the day is suspended. This is done to prevent excess losses to the players in the market. NSE has the following ranges for various securities: 2%, 5%, 10%, and 20%. Now, there are two different types of circuits. One is known as a script-wise circuit breaker, and the second one is known as a market-wide circuit breaker. Script-wise and market-wide circuit breakers are applied individually to in different scenarios. Script-wise breakers are applied to individual securities. For example, like we saw, if the stock priced at 100 yesterday moves beyond 105 or drops below 95, a circuit breaker would be triggered, stopping trade in just that specific stock. On the other hand, market-wide circuit breakers are triggered by significant movements in the broader market indices like the Sensex or Nifty. The threshold for these are typically set at 10% variation. That is, the range of variation allowed is plus or minus 10%. Now, how is this applied? The application of this 10% circuit breaker is done in the following manner. If the circuit breaker, either the upper or lower circuit, is breached before 1 p.m., then a 1 hour halt would be given, which is known as a cooling off period. Similarly, if this circuit is breached between 1 p.m. and 2:30 p.m., a 30-minute halt or a cooling off period would be given. On the other hand, if this circuit is breached after 2:30 p.m., there is no halt and the trading continues as it is. The circuit breakers are implemented in a phased wise manner in this way. Initial halt, at first threshold may be of 30 minutes, followed by 1 hour halt if the next threshold is breached. Should extreme volatility continue beyond these thresholds, trading might be suspended for the remainder of the day. But in case of market circuit breakers, it is not getting suspended. But in case of script-wise circuit breakers, it might be suspended. These measures are essential in preventing excessive losses and ensuring that market participants have enough time to understand what type of decisions that they have to take in the prevailing market conditions. In conclusion, circuit breakers serve as an essential risk management tool within stock exchanges globally. They safeguard against potential market crisis and protect investors' interest by ensuring trading is suspended during the periods of excessive price movement. Now, it is not like excessive price movement is just a negative price movement. Excessive price movement is also a positive price movement. That is, the stock prices continue to increase and increase very rapidly. On the other hand, if the stock prices continue to decrease and decrease very rapidly, that is also not good. As market evolves, so that the strategies to maintain their stability, circuit breakers become a pivotal component of this particular activity. Thank you for joining me today to understand critical role of circuit breakers in our financial markets. We will meet again.